And with that, I will introduce Tim Jackson. He is the National Sales Manager for the Financial Advisor Channel at Reverse Mortgage Funding. He's been in the industry for about 17 years. And on a personal note, he is a youth motivational speaker. He talks to middle school, high school, college, and military about youth motivational kinds of things, and we welcome him today. Thanks.
Thanks, Tammy. I think I'm on. Good afternoon, everyone. I'm pretty excited to be here today. It's, you know, for many of us in the audience, you may be sitting there thinking about what are reverse mortgages today, and why would I ever want to refer one of these to my clients? I want my clients to think I care about them, right? And so the HECM program that we're going to discuss today has actually gone through a pretty major regulatory overhaul. As of April 27, 2015, we started to see a much different story surrounding the new low-cost reverse mortgage. A lot of this has been made, you know, brought to the forefront by thought leaders like Harold Evensky of Evensky and Katz, Wade Pfau, who has recently written a book on the new low-cost reverse mortgage. John Salter has been producing white paper after white paper on how to use the new home equity conversion mortgage in retirement income planning. So today I'm going to talk to you a little bit about what the program is today. I'm going to tell you a little bit about the firm that I happen to work for to give you sort of a perspective from where we come at the business from, and then I'm going to go into the 4 common strategies that we're finding the majority of the planners that we work with through reverse mortgage funding and the way that they're incorporating the home equity conversion mortgage into the retirement plans of their clients. So to start off, the term HECM, or is short for home equity conversion mortgage. That may be a newer term for some of you in the audience. It's essentially the gold standard in reverse mortgages. More than 99% of reverse mortgages in the industry are produced through the government-insured home equity conversion mortgage. And just for the people in the audience here, the only product that we'll be talking about today is the government-insured reverse mortgage. Most planners find value in understanding that the product itself, although it's been changed pretty drastically through the years, it's been in place for a little over 28 years. It was signed into law under the Reagan administration through what may be a foreign term in today's political climate, something called bipartisan support. And the reason why that's important is because, you know, the mortgage industry as a whole has been through a lot. And without the support of both parties, identifying the fact that over 1 million older Americans have benefited from this program, without that support, the reverse mortgage that we see today probably wouldn't be in existence, right? And today, what I'd like to do is sort of paint a picture of a traditional line of credit, right, or a traditional mortgage, which the reverse mortgage operates, you know, quite similar to in a number of different ways. All right. What happened? Because we were just working. We're good?
Yeah, this was a different screen than the recording on the other end.
Appreciate that. Thank you. Is there anything behind me? All right. So the reverse mortgage that's in place today, the home equity conversion mortgage that's in place today, is only made possible by a mutual mortgage insurance fund. The mutual mortgage insurance fund today totals a little over $105 billion. That's billion with a B. And I'm going to reference that a couple of different times because when I go into the strategies that are being used with the home equity conversion mortgage today, often I'm asked, wait, how does that happen? That sounds too good to be true. that doesn't make sense. And I'll refer back to this $105 billion of insurance that allows for two key pieces with a home equity conversion mortgage that does not exist with a traditional mortgage. The first key is that once the HECM is put in force, it can never be called, canceled, or reduced by the lender. Because of that security, that's where Harold Evensky first started taking a look into the use of a HECM in retirement income planning, because essentially it was an instrument that could be put in force, and it's guaranteed until the client's 150th birthday, right? So the home equity conversion mortgage can be put in force, and then in addition to that, the money that's made available through the HECM, should that money ever exceed the actual value of the home, the insurance allows for a non-recourse feature, which means that should the client end up accessing more equity than actually exists in the home, the client nor the client's estate would ever be liable for it, right? So, any questions about that right there? Does that explain itself? All right, super. So I'm going to move on. I'm going to digress for a moment. I'm going to talk a little bit about reverse mortgage funding, the company that I work for. I've worked on and off for them for the last 17 years. The name on the door has changed a couple of different times. When I started, it used to be Bank of New York. It was sold to Everbank and then sold off to MetLife. And when MetLife met the Dodd-Frank Act, you were essentially dealing with a company, an insurance company that couldn't operate like a banking entity. So they let go of their mortgage company, their reverse mortgage company, and the banking entity all in one fell swoop. And the executives at that firm, Bob Savori, who's our COO, he helped create the lump sum fixed rate reverse mortgage that you would see in the space today. Our CEO, Craig Korn, helped securitize the first reverse mortgage in the secondary market about 15 years ago. And they're truly the innovators in the space. They set aside to create a fully integrated reverse mortgage company, one that specializes specifically in reverse mortgages and would use its marketing through an educational platform. So we specialize not only in educating financial planners and clients, we also happen to originate, process, fund our own loans, and then we have 100% servicing oversight. And the reason why this is important is because the profitability model that the company that I work for happens to have. You see, reverse mortgage funding is not only a Ginnie Mae issuer, but they're also a portfolio lender. So to paint a picture for you, if someone takes out a reverse mortgage and borrows a bunch of money, on day one, we become profitable. We're a Ginnie Mae issuer, so we'll wrap that up, we'll securitize it, sell it on the secondary market. Where we also, there's been a lot of chatter around a standby reverse mortgage, the idea of putting a reverse mortgage in place and not touching it. And what we've found through our financial advisor platform is that 50% of the lines of credit that we put in force are the true standby reverse mortgages. So with those, we would portfolio that. As a portfolio lender, we'll hold on to it and wait for the client to draw down on the funds. As they draw down on the funds, we'll wrap those up, securitize those, and sell those in the secondary market, making fee income down the line. What that's allowed us to do is not only eliminate the need to charge heavy origination fees, but we're also profitable enough where in many cases we're able to provide lender credits that allows us to put home equity conversion mortgages in force for as low as $125. So that idea of being able to put a reverse mortgage in place for $125, I mean, and to give you some perspective for those of you who haven't seen the industry before, I gave my wife's grandmother a reverse mortgage about 7 years ago. I should say my mother-in-law's mother. Like, it was really, we had to be careful, let's just say. it worked wonderfully. It kept my mother-in-law's mother in her home for the rest of her life. But the origination costs were around $17,000 to be able to put that in force. The reduction in cost, the creation of this no-load reverse mortgage has created a brand new conversation around, well, what does that product look like? And we're going to talk a little bit about that today. And further on with our company, so we didn't open our doors until 2014. They created the REIT, which is our parent company, in 2012. Essentially writing our first reverse mortgage in 2014, and we've seen some pretty rapid growth. Q1 of last year, you would have seen that 1 out of 5 home equity conversion mortgages had reverse mortgage funding's name on it. By Q3, we had a 28% market share, and by the end of 2016, we were the largest Ginnie Mae issuer of HECM mortgage-backed securities in the industry, which, is pretty rapid growth. But you have, some major institutional investors out there, guys with a lot of money, people with a lot of money, who were betting on the fact that the people who were once on top were going to be right back up there again. So moving on into why is the home equity conversion mortgage of value to the financial planning community? The biggest conversation around using the HECM is to mitigate risk, right? And there's all different types of risk that your clients are facing in retirement, whether it's market risk or spending risk, life risk, health risk, longevity risk, right? The idea of opening up a second pool of cash can be an absolute change maker in somebody's plan. So I'm going to illustrate for you what this would look like for a 62-year-old in a $600 and some odd $1,000 home in Pennsylvania. And here we're doing it for $125. I should let you know that this doesn't happen in all states. Florida and the greater D.C. area, there are mortgage taxes that make it difficult to be able to do it for this low cost. On lower valued homes, we also find it increasingly difficult to be able to pay down the cost as low as $125. But for the most part, the majority of the HECMs we're putting in force today, we're doing so for $125. We're here, we open up a line of credit that starts at around $300,000. So picture Mr. and Mrs. Jones in a $600,000 home who don't need a reverse mortgage, but they want some sort of a safety net, something to cover their what-ifs in life. So for $125, they put a HECM in force, whether it's 5 years, 5 months, or 5 days. If the client at any point in time wants to get out of the HECM, if they want to sell the property or just want to pay it off for any reason, it's important to understand that with the government-insured reverse mortgage, industry-wide, there's no gotcha. There's no prepayment penalty on any reverse mortgage out there. So you can put this in force, and if 5 months want to go by and you want to get out of it, I've had a client use this as a bridge loan to be able to purchase a second property. They paid $125 to borrow $150 essentially, and paid 3 months worth of interest and said goodbye to it, right? So you can get out of it at any time. However, if the client doesn't need it, they're not required to draw anything down. The line of credit on all government-insured reverse mortgages will grow in available funds over time, tax-free, guaranteed, no matter what happens to the value of the home. So that 10 years down the line, Mr. and Mrs. Jones here, who put this HECM in force, now at 62, 10 years later at 72, have a $600,000 line of credit. If 20 years go by and they haven't touched that line of credit, it's now grown to a $1.1 million pool of cash. Regardless of the home value, if the home value stays at roughly $600,000, that pool of money, the $1.1 million, is still available to the client. I see some people looking for the fine print here. I want to let you know that all of you are invited to a copy of this, along with some other material at the end. What it says down here at the fine print is, essentially the HECM itself, the rate at which the interest grows is made up of three factors. One is a margin, and in this illustration, the margin's 3.375, where today the majority of the HECMs we're putting in force have a 4% margin on it. In addition to that, there's a 1.25% mortgage insurance premium that's also fixed. So you got a fixed 4% margin and a fixed 1.25% mortgage insurance premium, which provides a guaranteed growth rate of 5.25% tax-free. That's a great question, and I appreciate that. I will get to that in 1 second. Just to finish up, the third factor, which increases the line of credit, is LIBOR, right? So you add those three, you not only get the interest rate that you would have been charged on any money that was borrowed or drawn down on. However, if you don't draw down on anything, then the line of credit grows at that exact same rate. So there's a number of different reasons why this occurs, right? When they created the reverse mortgage, they wanted to pay attention to the actuarial tables. With a reverse mortgage, the older you are, the more money you get. However, if someone were to draw down, let's say someone were to take out a reverse mortgage, and instead of opening a line of credit, they take out a lump sum distribution for one reason or another. Let's say they're eliminating a current mortgage on their property. Well, the debt 10 years down the line is $600,000. The debt 20 years down the line is $1.1 million. The risk is identical whether they're drawing down on the funds or leaving it in the line of credit. So there's that $105 billion of insurance. Well, how do the actuaries make that work? Well, a couple of things. If you take that $600,000 home and increase the value at 2% over a 20-year time period, 20 years from now, the home's going to be worth a little over $1 million. So her question is, does the debt mirror the line of credit? And absolutely. If someone draws down on it, it grows at the exact same rate. So again, the standby line of credit, which, you know, truly it's a flexible payment line of credit. If the clients want to make payments, they absolutely can. However, they're not required to. So that starts to open up some pretty interesting opportunities for someone to help mitigate sequence of return risk. Imagine having an extra pool of cash for your client who, again, doesn't need a home equity conversion mortgage, and then 2008 hits again, and you see their portfolios drop by 20, 30, 35, 40%. To be able to have that second bucket as a strategy, Harold Evensky, in his paper called The Standby Reverse Mortgage, published in the Journal of Financial Planning in 2012, talked specifically about that. What's not discussed in that article is, well, if I can use a two-bucket strategy to mitigate sequence of return risk, what does that start to do to a client's investment strategy during their retirement? And we're working on trying to produce results around that. What happens to a client if they know that what happens to their risk tolerance if they know they've got that second bucket to be able to mitigate any sort of downturn in the market? So, you know, at the very least, because of the increasing line of credit, Dr. Wade Pfau out of the American College, he says at the very least it's a put option on the value of the home, guaranteeing growth. We've got a planner by the name of Rob O'Dell down in Florida who's really taken to this. He just wrote an article in Bob Veery's blog on his application, right? So one of the things that Rob's done is he lives in a golfing community down in Florida. And if you pay attention to golf rates among Americans, it's like baseball, right? It's becoming less popular. So we've got an entire community of people whose houses and the values of the homes are tied to the golf course, which people aren't golfing as much, and they're concerned about a decrease in the value of homes. So he's got over a dozen clients in the neighborhood who have put HECMs in force in order to guarantee that the money they've invested into their homes is going to be there when they want to vacate, right? As far as other strategies that are concerned, and maybe I should pause there and see if there's any other questions about the growth feature in the line of credit. Yes, sir? Correct. So his question is about the home equity conversion mortgage being tied to the primary residence. Absolutely. Reverse mortgages have to be on your primary residence. So if it's let's say you've got a snowbird living down in Florida, right? They've got to maintain this as their primary residence, living there, you know, half a year and 1 day out of the year to be able to consider it their primary residence. Once they vacate the property, the loan comes due and payable essentially, right? So if you've drawn down nothing, well, let me give you the little catch, right? The minimum balance on all home equity conversion mortgages through reverse mortgage funding is $50. Has more to do with compliance than it does us trying to make $3 a year in interest. So if somebody, you know, had a $50 balance over a period of 5 years or 10 years, I mean, you know, maybe that's grown to $100 or whatever. But you pay that down, and essentially the home again is free and clear. Yes. Correct. That's a great question, and absolutely unequivocally not. Yeah, once you put the HECM in force, this one in particular, now look, we have 75 different products that we offer. This illustration right here, right, this sort of no-brainer. I've got 5 family members who have the new home equity conversion mortgage because it's so simple, right? It's so simple, most people end up missing it. Where you put this in force, you have to have a $50 balance. Year over year, they're charging you, you know, let's say 6% interest. That's going to compound in interest. If you want to, you could pay the $3 each year to buy it down to the $50 minimum. Other than that, there are no carrying costs. As that line of credit grows and you haven't drawn down on anything, they are not charging you more fees on top of that. All right, I'm gonna take 2 more, and then I'm just gonna keep on going on. So I see one. Go ahead. So the maximum you could borrow against the current property, it's a factor that has to do with your age, the value of your home, and the going interest rates. You want to presume roughly 50% of the value of the home. Again, not all reverse mortgages are created equal. We have lower margins that produce a greater percentage of the value of the home, higher margins that produce lower, yet yield a better return on the line of credit. For something like that, right, if you had a client in mind, we'd talk about running an illustration at some point. Thank you for the question. Yes, miss?
But just tell me if we're going to cover this later, but if somebody, for example, took out and got the 3.75, and 10 years later, they're selling their house, is the 613 that, as long as it's, they would, okay, it would be the higher, the lower of what the value of the house is that would get paid back?
Sure. So her question is, let's say that 10 years go by and the value of the home is dropped down to $500,000. And the client, in either case, right, if they have a line of credit for $600,000, then my advice would be take all the money out of it, put it into your bank account, and you could do what's called a deed in lieu. You can hand the keys right over to the lending institution. Or you could sell the property, sell it for $500,000, and then the shortfall, the $100,000 shortfall, would be made up by that $105 billion in insurance. Okay? So I'm going to, does that answer your question? I'm sorry. Correct. So same thing, right? Whether you draw it out here on the 10th year anniversary, or you take out $300,000 and the debt's grown to $613,000, you sell the home for $500,000, or you could do a deed in lieu. Because of the non-recourse factor that is tied to the home equity conversion mortgage, you can never owe more than the home is worth. You can never pass debt down onto your estate. Even if you have $1 million life insurance policy and $5 million in assets, the lender, the reverse mortgage is tied to the house, not to the client or their personal credit. Okay? So moving forward with this strategy, again, let's picture the Joneses, right? Mr. and Mrs. Jones open up that, and you're going to look at the same numbers that you just saw. 62-year-old, $600,000 home, open up a $300,000 line of credit that has grown to $600,000. And now what I'm starting to illustrate for you is the annual growth that's occurring in the line. So that 20 years out, the line of credit's growing at $67,000 a year. That's that 5.85%, which is what this illustration is based on, right? Times the $1.1 million, that's what you would find. Now picture Mrs. Jones, who put this in force, Mr. and Mrs. Jones put this in force, and they never thought that they would need this. But Mr. Jones might have checked the wrong box on his pension, right? Perhaps he passes away at age 82 and we lose half of his pension. Mrs. Jones now also, she gets his death benefit, but she just lost her Social Security income. One of the strategies that is being used out there is as a deferred line of credit, putting this in force. And now one of the options that Mrs. Jones would have to her is if she wanted to, she could draw down $67,000 a year, tax-free, every single year until her 150th birthday. And effectively, she hasn't even touched the line of credit. So fast forward another 10 years. Mrs. Jones is now 92 years old. She's drawn down at a zero, $670,000. That $1.1 million is still available to her. If she comes into the office and at 92 says, I can't physically afford to live in my home any longer, she can move that money into her checking account. She could buy her way into a facility of her choosing, no matter what the value of the home is. We've now made available to her a little over, add 670 to 1.149, you're going to get a little over $1.8 million has been made available to the client through the government-insured reverse mortgage. So next time you see an article in Investment News that says 9 different ways to use a reverse mortgage, next time you see, my experience has been that once planners start to find out about this, once they start to see how it works and to run the numbers, the probabilities of success for their clients increases. And what the researchers have found is that not only does the probability of success go up, but we're increasing legacy values as well. Because when you open up a second bucket to be able to handle a number of different what-ifs in life, I heard a planner the other day remarked, he goes, the reverse mortgage, it'll solve one problem for my clients. I just need to leave it up to my clients as to which problem it'll solve. I have a question in the back. Correct. She'd need to take the money out prior to moving into the long-term care facility. Absolutely. Yep. Correct. Now, I've had clients call me up, hey, or the adult children of clients, mom has moved into a facility. She's, been there for a month. We're not sure if she's coming back. We're going to need money for long-term pay. And it's, okay, draw the money out, put it in the checking account, and use that to pay for her care. Put the home on the market, sell it for whatever you can. If there's equity left, that's yours. If there's not, there's no recourse to worry about. And meanwhile, you've moved all of those available funds into a checking account, which can be passed down to her children. So the question's about a primary mortgage on the home, and I'm gonna pause questions again with that because this is one of the 4 strategies that the HECM is being used for today, right? And essentially, I'm gonna speed through this. For most of us, we probably understand how 5.5% adds on to $100,000. That's how the line of credit grows, again, by those 3 factors. You look like you're reading it, so I just want to make sure that I'm not. Okay. So this piece comes from Wade, who's, we've got a copy of Wade Pfau's book on reverse mortgages here. We're going to make it available to everybody who's attended this course if you want a copy of this book so that you can see the research that he's done. Essentially what Wade says is that by using the reverse mortgage through a coordinated strategy, we're increasing probabilities and legacy values. That last part is a completely different conversation. Having spent 17 years in this industry, I'm intimately familiar with the idea that, oh, reverse mortgages, that's a neat loan of last resort. You know, that's a pretty neat tool for some of my clients, but, you know, those are only it's not the majority of my clients, and it's really the people that I'm helping out, you know. Where today the conversation is saying using a coordinated strategy, using a reverse mortgage is actually increasing the amount of money that we're leaving to an estate. There's a number of different ways that we can do that, and let me show you how we model that. Oh, I'm sorry. So this comes to us borrowed with permission from Harold Avensky, right? Where essentially what Harold says is that when you compare a traditional line of credit, which today over 4 million older Americans, half of older American homeowners have a traditional line of credit, which could be called, canceled, or reduced at any point in time, right? If the market values drop like my home did in 2008 and I got a letter in the mail, Tim, we've reduced your line of credit from $75,000 down to $23,500. They couldn't reduce it any lower. Like that's the maximum they could reduce it. That would never happen with a reverse mortgage line of credit because of that safety alone. When you take a look at it, you qualify at age 62 to go from a traditional line of credit to a HECM line of credit, which when you look at the benefits and features, it's kind of like going from a BlackBerry to an iPhone. They're two completely different tools. One is meant for somebody 20, 30, 40, 50 years old, right? Where when you take a look at the way the HECM is created, because of the flexible payment feature, it's ideal for somebody in the distribution phase. So here we're going to model a couple. This is a 62-year-old couple with $1.5 million portfolio. And I'm sure we're familiar with the average American who's going to say, I've got $1.5 million, I'll never have to worry. But when we start to model this in MoneyGuide Pro, what we found was that because of a long-term care event at age 85 of $75,000 a year, there's less than a 40% likelihood of success, and the client runs out of money by 2040. So does anybody here use MoneyGuide Pro? So we also have CE courses on how to model HECM reverse mortgages in MoneyGuide Pro. When MoneyGuide Pro pulls their calculations, they're pulling directly from reverse mortgage funding. We integrate with PITech, Bob Curtis, and the gang of all. We put on a webinar the other day where it's, you know, the power of what happens when you can show a reverse mortgage, what that does for the client to be able to see, wow, I'm in trouble, to what happens when we model the client at age 85, let's say the spouse takes out that $75,000 a year long-term care costs. We find that not only does the probability of success go up, but because the client isn't pulling down on their portfolio, for those non-MoneyGuide Pro users, MoneyGuide Pro calls the safety margin, that's what they're labeling the money that's in the portfolio at the end of plan. We now, instead of running out of money, there's $750,000. Now, when we encourage the planner to explain to the client in this position, well, you're not truly using the HECM to its fullest ability. What if once the husband passes away, the spouse continues to draw down $75,000 a year until the end of her life? And that's where you see the magic start to happen. Because not only did we turn somebody's retirement around, but the money left in the portfolio, for those in the back of the room, is $2.1 million. They have more money at the end of plan than what they actually started with because they started to draw down on home equity. I'm going to move along because we're short on time, and this is still the first common use. These others move much quicker, right? So I want you to think of clients who perhaps are at risk of not meeting their goals, right? And we're going to illustrate for you here a 62-year-old in a $625,000 home who decides to, like you hear on the commercials, your home can pay you tax-free, guaranteed for the rest of your life. They're accurate, right? Those commercials are accurate. I wish they weren't on TV at 2 o'clock in the morning, but you know, they're being truthful. Here we start to illustrate a couple, husband and wife, put this in force. Now, if 2 months go by and the husband passes away, it's a last to die policy. It's a second to die policy. The money would last until the spouses, right? In this case, the husband passes away, whether it's the husband or the wife or modern marriages, same-sex couples. You put this in force, and the client would receive 1881 tax-free, guaranteed until the rest of her life, so that over a 40-year time period, she's drawn down $900,000 in tax-free funds. To the question, somebody said, someone was asking about the percentage of the value of the home that you can get. And the older you are, to that point, the more money you can get. And we illustrate here through the tenured program, right? So it's similar to an annuity, only you've got to remain in the home for the rest of your life. So there is that caveat here, right? We put the HECM in force, and the client's receiving, at age 82, they're getting $3,200 a month. Spouse passes away 2 months later, and they continue to receive the funds up until their 150th birthday. Any questions about how that part works? Great. Moving on. So the idea that the older you are, the more money you get, started a conversation where people were saying, all right, well, now I should wait until I'm older because I'll get more money. And unfortunately, that advice is dead wrong, right? Wade Pfau, in his research, identified that putting the reverse mortgage in force as a loan of last resort, of all the strategies that he studied, is the worst of them. It's the worst time to do it. But to put it in advance, and here we illustrate that, yeah, at 72 years old, you are going to qualify for an extra $42,000 above what a 62-year-old would. However, when you factor in the growth of the line of credit and what that does, I mean, everybody here understands the power of compound interest. If we could just explain that to the rest of the country, we might be in a better spot, right? So I'm going to now talk about what happens with a client who has a mortgage on their property. And here, this is a real-life example for a planner where we ran this illustration down in Virginia. 65 and 67-year-old couple who had a $500,000 portfolio. Sizable home value, $600,000 home with not a terribly large mortgage on the property, $98,000. However, the monthly cost for that, $1,500 a month, $18,000 a year. For this client, she was pulling out of her IRA in order to be able to make those payments. $18,000 a year quickly turns into $28,000 a year. And when you model that, again, we're running out of money by 2028, and the client's well below 40% probability of success. So what we talked to the clients about in this particular situation was, well, what happens if we eliminate that $1,500 a month debt service, and because the mortgage is only $98,000, they qualify for more money. We also give them an additional $1,500 a month. There's a $3,000 a month swing as a result. When we do that, the money's lasting till the end of plan. And this part right here usually, right? So you see 61, and that's, going to be better than below 40%. But if it's my mom and dad, I see a 39% likelihood that my mom and dad are moving in with me. Not going to, or worse, my in-laws, right? So you got to come up with something. And what we talked to this client about and convinced them to do is a home equity conversion mortgage for purchase. Now, the reverse mortgage, it's usually pretty surprising to people to understand that just like you could buy a home with a mortgage with payments, you can also buy a home with a reverse mortgage that is payment flexible or has no payments. So here, we convince the client to sell their $600,000 home. We take $200,000, we use that to fund the purchase of a new property and reverse mortgage the other, giving the client an extra $100,000 or $200,000 into the portfolio, which is why we're seeing such an increase in the probability of success. When you think about your clients who may be making moves, and the last study I saw said that 35% of people, 35% of retirees over the age of 65 plan on making a move, whether it's downsizing or upsizing. The term we've been using is right-sizing, right? We want to right-size my own mother and stepfather. Now, I'll tell you, I wouldn't have talked to my own mother and stepfather about this prior to April 27, 2013. April 27, 2015 is when the spousal protection law went into place. So my mom's 65, stepdad's a decade younger than her. He's got longevity in his family. And he's only like 14 years older than me or something ridiculous. You know what I mean? Like, I'm worried about him I'm 80, he's 94, running around turning on the gas knobs. I need to keep him out of my home. So because of a new spousal protection law, which, again, has really turned the conversation surrounding reverse mortgages. And if you did a search, right, October of 2013, we found that 14 out of 15 articles online were negative about reverse mortgages. In January of this year, they found 19 out of 20 articles online were positive about reverse mortgages. The changes that they've made, and if you look at that 5% of articles that are negative, it's just people who don't have the right information, right? There's old data, there's old stories out there. The new low-cost reverse mortgage that is government insured and regulated by the Department of Housing and Urban Development and the Federal Housing Authority is something that more and more planners are using at a very rapid rate. So here, again, to put that purchase picture in mind, here's a client, and I don't particularly care for this because I don't know anybody with a planner who's going to take $200,000 out of an IRA and pay $60,000 in taxes. However, here's scenario one. You could buy a home with a large withdrawal or taking out a regular mortgage, or you could buy a home with a mortgage that doesn't have payments. Does anyone have any questions about the reverse mortgage for purchase? I thought I saw a hand. Did it go down? Questions answered? Yes.
One quick question. Can it be based on being younger of the two if we had a married couple?
Absolutely. Absolutely. So, that's what my parents face, right? With a 54-year-old, the new law allows us to take a look at my stepfather's age. At 54 or 55, I forget how old he is. And they'll provide them with a percentage of the value of the home. So rather than 50%, perhaps they're getting more like 45%. As long as one member of the household is over the age of 62, a reverse mortgage is absolutely possible. Correct. As far as suitability is concerned, that's where at Reverse Mortgage Funding we really, I would say we specialize in dealing with financial planners and the unique needs that you see your clients running into to help you determine where should a reverse mortgage be an option. If you take a look again at the thought leaders out there, what you have are some of the brightest minds. I'm going to be down in Dallas. I fly to Dallas tonight for the FA magazine. We're going to be I'm running a panel with Wade Pfau and John Salter, who have a presentation that's very similar to this. I saw John give his presentation to the Garrett Planning Network out in Colorado last year, and one of the planners said, "John, you make it sound like you'd recommend this for someone with $2 or $3 million in investable assets." And John started laughing, and he goes, No. I need anyone in the audience who is in this gentleman's camp to, I want to be clear that you're completely misunderstanding me. John works with Harold at Evensky & Katz, he said, because we just closed on a client who's got $9 million in assets under management. Because why wouldn't we want to provide our clients with liquidity? Why wouldn't we want to give them a line of credit that would never be called, canceled, or reduced? Why wouldn't we want to put our clients in a position where they never have to worry about a forced sale? right? It's that type of thinking which has made Harold Avensky implore financial planners to just take a fresh look at what the new reverse mortgage is. So, you know, essentially what we do is, in working with planners, we ask you to take a look at your client base. And, you know, ask yourself this question right now: which one of these 4 categories is most relevant for you? Whether it's clients with less than $1 million in savings, those with no long-term care, those who are still making a mortgage payment in retirement, or those who are moving. And if you can identify that, we've got 3 reverse mortgage funding reps here today. Rick Brown, Larry McInerney, and Mike Ryrostek are going to be here. They're going to be handing out cards to you. For anybody, is anyone in the audience interested in this book? Okay. So we'll pass around these cards. All you got to do is simply fill out a little bit of information, and we'll get in contact with you and give you a free copy of Wade Pfau's book. We certainly want to put that in your hands. And what's been most helpful for the majority of planners to wrap their head around this is to look at the numbers. So I'm educating planners. I probably run 2 or 3 webinars a day, one-on-ones often, sometimes in entire offices. And last week I did this, and somebody sent me over 12 client illustrations. I wouldn't recommend doing that. I think that that's it's kind of almost too much to gather, right? I had this planner in particular pump the brakes. If you could think of 1, 2, maybe 3 clients at most, where you'd like to see what the numbers look like, with some very basic information, we can give you a pretty detailed analysis of how this would look for a client of yours. And I've got 8 minutes for questions. Go ahead.
In the situation where a client does not fully utilize the HECM and there is equity left over, so you're saying take it out and leave it there, because the house is basically been gone, right?
So I'm not sure if I understood the question entirely. Let me give you a couple different scenarios just to cover it, because people may have offshoots of that. With the home equity conversion mortgage, if at the end of a client's plan they have a $300,000 line of credit and the home value is worth $500,000, you could simply allow that client to, you know, pass away. The children would inherit the property. If the client has only drawn down $100,000 from that, well, then the estate would inherit the property. They could sell the home for $500,000, pay off the $100,000, and the $400,000 in equity that is left over is theirs to keep. I want to be crystal clear here when I say the bank does not own the home. You're not signing the title of the home over to the lending institution. That's, again, an industry standard with the government-insured reverse mortgage. It's probably still the largest misconception out there about this program. Yes, ma'am.
Maximize the legacy issue, say mom's in the home, is getting help at home, who wants to stay in the house. But if you want to draw down on that line, we have to do that one time.
So her question, her question is about how to access the funds once mom becomes not mentally capable to or physically capable to make her own financial decisions. And, you know, we've got a pretty good crack team of attorneys who know how to work within the law. If you were dealing with any one of the reps in the building today, what you'll find is that they'll recommend that a power of attorney is created, you know, somewhere along the process.
I think this is good, but what I meant was that for some guys who get money down on the loan, the house in the estate, the staff, is the line still there, or is that go away?
Sure. So let me answer this by telling a story of a client of mine, an actual client of mine in Bergen County, New Jersey, who opened up a $250,000 line of credit on a $400,000 home in 2006. Fast forward to 2011, and things went the other way. The adult child of the client called me up a week before she had passed away. Mom's not doing well. Hospice is coming in. He had power of attorney. I advised him to take the money out of the line of credit, put it into the checking account. When she passed away, he took everything out of the house and handed the keys over to the lending institution. That's what I would recommend, again, for a client in that situation. Yes. I see a question in the back. Yes, sir. You are 100% accurate. I saw this gentleman first. Go ahead.
Picking up on that thought, what makes it viable is the fact that there's this big pool of insurance, right?
Correct.
So if most of the people who apply for the loan take advantage of the line of credit feature, who's paying any premium in to accumulate in this big pool of?
So the question is, how are the actuaries figuring out? And it's a two-part answer, right? Number one, to put that line of credit in force, the costs in Pennsylvania are going to run somewhere around $8,000 to do that. The lending institution that I work for will credit those monies. In that $8,000, there's a $3,215 or $120, a $3,000 insurance premium that the lender, in this case, is buying into in order to do that. In addition to that, over the last decade, there have been 4 principal limit changes to the reverse mortgage. We've seen adjustments to the cost of the insurance. Anybody who's in this, like file and suspend, right? Anyone who takes advantage of that early on ends up benefiting greatly. And Wade talks about that in his book. He's more concerned about it than the rest of the scholars are, because essentially nobody's talking about that concern yet. However, the actuaries review this stuff annually, which, is that, along with the fact that we're in a low interest rate environment right now, is playing to the fact of, look, the people who get into it today will certainly be the ones that drastically benefit compared to those who delay. Thank you for the question. So the question is there something in place in order to monitor the homes? And I would say, similar to the rest of the mortgage industry, there aren't mortgage police out there knocking on the homes, making sure that, I'm sorry? If you violate the terms of the loan, yeah. So again, you got to occupy the property as your primary residence. You got to pay your property taxes and your homeowner's insurance. Oh, I think I got something, right? You need to pay your property taxes and homeowner's insurance, and then in addition to that, you have to maintain the property, right? And where does that pop up? Well, it pops up when you have a house fire or you make an insurance claim, and the insurance company is going to notify the lending institution that there's been an event happen. And, for the most part, they've got that over the last 28 years down to a science. Does that answer the question? There's nobody knocking on doors. Absolutely not. Yes, miss? Correct. Yeah. So they do. The question is about the appraisal process. We use a government-insured FHA appraiser, which is required. I'm coming up on 4 o'clock, so I apologize. We will be out here for questions for the duration. Again, we're handing out cards to be able to get a copy of Wade Pfau's book on reverse mortgages, how to use reverse mortgages to secure your retirement. This is much better suited for a financial planner than it is a client. From what I understand, Wade's working on a part 2 that's supposed to be client-facing. Yeah, I want to thank everybody for your time and attention. I really appreciate it.